Welcome to the daily update, where I'll go over the action in the market for Thursday, July 10th, and we'll see how things look for Friday, July 11th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, setting another new all-time high with the S&P, the NASDAQ 100. Growth kind of underperformed. Mega caps did okay, but not great. We saw value doing a little bit better, but we're seeing more broad participation within the S&P 500, and that is typically seen as positive. So right at the open, we had a lower open, and it looked like, okay, maybe we're getting a little too exuberant because we're still really high as far as sentiment. We're still coming in at 75 with the reading, and that's when we think, okay, we're at least due for some consolidation, moving sideways, maybe a little bit of a pullback or a decline. But then anytime there's any sign of weakness coming into the market, the buy the dippers come right in, and it seemed to work in Thursday's session. So we did open lower, and we found support right at the daily pivot at 62.55. So we're getting above that 62.50 level, and then we climbed and went positive above the unchanged level, and we hit resistance initially there at R1 at 62.78, but we were able to hold on to the gains. We didn't see a bounce down from that. We just kind of hung out around those levels, and then we're able to climb above R1. But then we hit resistance at another round number. Apparently, the S&P is not quite ready to deal with 6,300. It got up to 62.90, and that's pretty much where we topped out for the day, and we closed slightly above R1. So we did come down a little bit going into the close. And on a percentage basis, the chart looks like we had a really strong up day, but on a percentage basis, we were only up 0.27%. We're still below average with volume, and as I keep saying, that's usually typical in the summer months. We are positive across all time frames. We are trending. We are looking overextended, and I'll go through the list, not only by what most of our charts are saying, but on a sentiment basis as well. Interest rates were virtually unchanged, went down a little bit there, but that didn't really seem to give some support to stocks. They just wanted to go up anyway. Okay, so both, or I should say all three, the S&P, NASDAQ 100 did set all-time highs. And even the Dow's getting close to a golden cross. It still has a ways to go to get back to its all-time high. And another good day for small and mid caps. They're showing signs of improvement, and that's lasting more than just 1 or 2 days where we see a nice little upward move and then they get back to gains. We'll see if that can continue to move forward as well. And our short-term list, we still don't have the Stoke RSI on here. That's not showing real strong short-term momentum, but other indicators are. The Williams percent are, the CCI 20, and still the CCI 14 is not on the list yet. Stochastics are still showing good short-term momentum in the short-term, intermediate short-term, and long short-term. Our oscillators, they've been positive now, but they're also giving extreme readings as well. And we still are far away from the 20-period moving average, and the RSI, the short term, that continues to show good short-term momentum. But this is more of an overbought signal that we're getting from this. The advanced decline ratio, which had gone extreme a few sessions ago, then it worked its way down. Now it's back up to looking extreme again. TTM squeeze, that's continuing to go up and looking extreme. We're still in the +3 channel with the standard deviations chart. The rate of change 50, still giving a high reading. The momentum oscillators, and I'll show you a chart of all those oscillators. The Sean trend meter, and we're also still far away from the 50-period moving average. Bullish percent indexes for the S&P and NASDAQ 100, extreme, and then also our intermediate term RSI is giving an overbought signal there. haven't really changed anything with the overall scenario. The Fed's still kind of remaining in the background, even though the meeting minutes came out on Wednesday. It really didn't give much of insight as to what's actually happening there. The dollar was up, so we're still seeing a bit of a bounce after it's been really declining a lot lately, but it's still in a downtrend overall, both on the daily chart and on the weekly chart. And interest rates, I think I said they ticked down. We actually ticked up 4.35% from 4.34%. Sentiment is still extreme positive. This is what's causing a little bit more concern. Now, if you remember back into March and into April, we were camped at extreme negative sentiment for many, many, many days, multiple, like a couple of weeks at least there. I don't remember the exact number of days. And we just camped out there where usually we come down, it's a washout in the market, and then we bounce up out of that. We're seeing a similar type of thing now, but this is seen as more positive where we can drift at high sentiment for a while. It doesn't necessarily mean a reversal. It just means that, okay, the market's a little too positive right now, and at some point, folks are going to want to come in and take some profits. And we are trending. We're positive, looking still pretty solid there with the ADX. We're above the moving average. We're above 20. And the green line is above the red line. With the update, the bias is positive and the momentum continues to be positive. And we had probably what's usually would be one of the slower economic report days. This was probably the biggest one of the week. We had initial jobless claims coming in, and these are still looking solid. And this is pretty much going against the idea that the Fed will cut rates later in July. But it's suggesting, at least with the initial claims, that the employment situation is hanging in there pretty good. We came in lower than expected at 227,000. The expectation was that we would receive 245,000. So this was stronger than expected. What's giving us a little bit more concern, and we've been seeing this now for a while, are the continuing claims are continuing to be increasing here, 1.965 million. Now we get a little bit more concerned if we go above 2 million, and we're getting kind of close to that. But we've been seeing initial jobless claims going down with continuing claims rising. So folks are not getting let go from their jobs, but those people that do lose their jobs are having a more difficult time. It takes them longer to find a new job. So here is the chart of the claims, the initial claims here. We are declining, and we're back in this range that we've been in now for quite some time. And this is showing that the employment situation is hanging in there, but we're continuing to go up here with the continuing claims, and that's a little bit of a concern. And putting them all together with the most recent unemployment rate, where the blue line, those are the continuing claims, the red line are the initial claims, and the unemployment rate right now is at 4.1%. So this is a little bit of a concern with continuing claims, but for the most part, we're still seeing job growth. These numbers are still coming in fairly economic friendly. And so that's lowering the possibility of the Fed cutting rates to try to stimulate employment, because it doesn't seem to need much stimulation right now. All right, then a number of charts to go through here. This is net bullish sentiment coming in. It has been going up. When we were really coming down back in March and into April, we got down to a minus 2.68. Now we're starting to see this, excuse me, improve as the market has been going back up, and there's some other historical events attached to this chart. Then 2025 is the Rocky Balboa market. When it has a down day, what happens after that? It's usually an up day kind of a thing. Over here on the right-hand side with positive returns. So this is also, you can see buy the dippers coming in within the trading session each day. This is more, okay, today was a down day, I'll buy tomorrow. That's more of an end of day type of buy the dip approach. Equities typically rise when the Fed resumes cutting. Okay, and you have to take the context. And every time we see this chart, and there's been times I've showed this chart quite a bit, why are they cutting rates if they do cut rates? Is it because the economy is doing quite well and they just want to help it do even a little bit better? That's more positive. Are they cutting rates because employment's going down, the economic reports coming out are much weaker than expected, and we're having a slowdown, and so the Fed comes in to stimulate the economy that way? You have to know the context behind why the Fed would be coming in and cutting rates. But the market usually likes that. Sometimes that can be just a short-term thing because everybody's just, oh my gosh, the Fed's going to cut rates, so we're going to go up. But then you look at the bigger picture of what's actually happening, and is that positive or is it negative? The basic backdrop of the economy. And earnings season are typically positive for equities, with the S&P averaging 2% in the first 4 weeks of reporting. We're going to start coming into earnings season now. The banks will be reporting soon. Those are usually the big companies that do that. And so far, it's been treated as positive. And then number of days above the 20 period moving average. And this is what I use as, excuse me, the short term definition. If prices above the 20 period moving average, we're positive. If we're below that in the short term, then we're considered negative. And this has been quite a while here. We're 52 trading days so far above the 20-day moving average once we finally started to rebound. Okay, and then the year-to-date intraday returns, and they re-index this to try to make it what they wanted to say here. But for a while, when we were really going down, we saw most of the losses coming in the overnight session when the futures were trading, and then we would typically have a gap down, and then there would be some days when we would have a gap up, and that would be most of the gains for that day, and then the cash session would play out, and we wouldn't see much movement. What we've been seeing now is where the futures are kind of more subtle. They're not moving as much. Like we might have a flat open, a slightly higher, lower open, but most of the actual price activity is happening during the trading session itself, and that's what this chart's trying to show here. Distribution of S&P 500 year-end price targets. Okay. And of course, when we were going down, everybody was revising their forecast down. Now that we've been going back up, we're seeing a lot of revisions going back up here. And these are just different. And we have the whole gambit here. Below 5,500 to the downside, above 6,900 to the upside. Goldman Sachs is coming in at about 6,600. Okay. I don't forecast myself. I just watch things on a day in and day out basis because, I mean, these are professionals and look at how wide their range is. And so how do you think we can come up with some kind of a reliable target? That's where I come out on that. Magnificent Seven forward-looking PE. I usually go over this in the weekend video with the intermarket analysis video. And not a real surprise here. We see the dark blue line above the rest of the S&P 500. These are the really big stocks, and they're already expensive, but as long as they keep going up, they're going to get more expensive, and people like that because they're looking for capital gains. And going with the flow, the market is up and strategist forecasts are up even more. Yeah, since we've been going back up, we're seeing how the forecasts are starting to improve here. And then looking at sharp rallies. Today's caps on one of the greatest 3-month rallies in history, up more than 25%. If you go back over the last 3 months when we were at the lows in April and to where we're at now, it's been a real V bounce out of that decline that we saw. It turns out this is extremely bullish. Only 5 other times in history has this happened, and continued strength was perfectly normal, up another 22% a year later on average, and never lower. So once we've seen a bounce like this, like we saw the COVID crash, that everything went down and then we V bounced up out of that. Well, what happens going forward here? According to Carson, we have very good results, not as much a month out, but we're up 100% of the time if you go 3-6 months out or a year out. And then the actual returns that we see as well, and they're quite impressive. And then triple golden cross. What happens when you have the S&P and the NASDAQ and the Dow, which is getting close, And they're trying to predict here. As long as we stay above both of those moving averages, they think that we'll actually have a golden cross on the 15th here. Golden crosses may not be nearly as positive of an indicator that some technicians view. I see them as important. They do lag, so they can go kind of slow, but if they form the foundation of, okay, what is happening as far as the trend. But when all of the major indices have experienced one within weeks of each other, and I know the perma bears are like, well, okay, the NASDAQ's hitting one, but the Dow's not. We're crashing, man. We're going down 50%. They don't have to happen all on the same day. They just have to happen generally within the same time frame. It's usually been a bullish signal when you look out into the future, and whether it's months ahead or years ahead. So here is, we're coming back up here with the 50 period moving average getting closer to actually generating a golden cross, where we've already seen that with the NASDAQ 100, and the S&P. We haven't seen it with the mid caps and small caps. Even though they had a pretty good day and they're improving, they got a long ways to go there. Now we're wondering if the Dow can generate a golden cross. And then what is the performance? And the further out that you look, the better the performance tends to be. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here's the chart. It looked like we were likely to have more of a down day, but that didn't last very long. We had a lower open, but we did set up some support here at the daily pivot. And then from there, we bounced up and actually went positive. And we went up to R1. It looked like, okay, maybe we're going to stall out here. And there was an initial pullback, but it didn't see an awful lot of follow through. So then we were able to break above R1. We didn't get up to R2, but we did get up to 62.90. And then we drifted down here going into the close, coming back down and just a little bit above R1. So not a lot of strength going into the close, but we were able to hold on to a portion of the gains that were seen earlier in the day. And we're down a little bit in the initial overnight session here, but you can see the kind of pinkish area. These have been rather muted lately, and we're seeing most of the price movement actually coming while the market is open, and that's what that previous chart was talking about. And we're seeing growth and value intraday kind of equaling up with each other here, and a little bit of an improvement. But when we look at the S&P growth to value ratio, we take it from, this was July 1st, when a lot of money managers and mutual funds, they were loading up on value stocks, and that really caused us to go down. And we've been holding up okay, but we're not really seeing this really breaking out right now. So growth was up barely, where value was up. So growth underperformed for the large caps. It also underperformed with the mid caps as well as the small caps. So these are the rest of the stocks in the S&P, not just the big growth stocks that were up. So we're coming down a little bit, but still positive overall with the small cap growth to value ratio, mid cap growth to value ratio, and still looking okay here with the S&P growth to value ratio. Still looking all right with this growth to value ratio here. We are seeing some improvement in discretionary. You can see the equal weight is showing some more strength here, getting really close to a golden cross, where staples are just kind of going sideways, and that's causing the ratio to come back up. So we were holding up above the 200-day moving average, and we're starting to see a golden cross now with this ratio. And here's the short-term trend above the moving average, green line above the red line. Everything is above 20. That's looking positive. And we're looking positive with the intermediate term, the green line above the red line. But we continue to be below average with volume here, and that may continue now, especially throughout the summer months. We are dropping with the VIX, and usually when we go up with the S&P, the VIX does go down, both with the line chart and the bar chart. And we're seeing a drop down below the moving averages with the VIX of the VIX as well. We declined with this fear gauge, and we're also declining with the other fear gauge. Not very much, but at least they're confirming that we're seeing some fear coming out of the market. Sentiment continues to improve. We did see a drop off with the equity put call ratio daily chart, and we're turning back down, but we're still below this red line, which is usually the extreme reading with the 5-day chart. And we're kind of going sideways right now with the 10-day chart. And we did get every week the individual investor survey. They're actually coming down. They're not quite as positive as they were from the recent reading, but it's still above zero here. So they're leaning more positive with the individual investors. This is just showing that the risk on is continuing to go up, and that's more positive. And we're also going up with the high beta versus low beta ratio. That's also more positive for the market. Coming down a little bit here, we've been going sideways above the band here, mostly with the volatility risk premium. So not a real spike there either, but it's still a little more elevated than what we've seen before. We're still looking good here with the advanced decline line based on price and volume, either at or setting a new all-time high with each of these. And we're getting kind of extreme again with the advanced decline oscillator. We had come up, then we dropped down. Now we're going back up to an extreme reading. Again, when we get these high readings, it does not mean a reversal. It may mean that we just might slow down a little bit. And we're positive with both the short and intermediate term advanced decline ratio. We saw a nice little expansion of the new highs, really no expansion of the new lows, but we are starting to roll over a little bit with the 5-day chart because this has been declining overall lately with the new highs, and we're pretty much flat, trying to turn up a little bit here with the 10-day chart. And all three of our smart money indicators are now back to positive. We're positive when we look at accumulation distribution above the moving average and going up, and we're just barely crossing back above the moving average with the boom indicator. And we're still going up with the chicken money flow, even though the histogram did come down slightly. And we crossed just barely back above the moving average with the chicken oscillator. Vortex, green line going up, red line going down. We want to keep an eye on this because you notice other times when we get a very low reading, even though it's positive, we get down to this red line here that, again, it doesn't mean a reversal. It just might mean that we slow down. So if this continues to go down, we'll be watching that. And if we start to get a really high reading here, usually about at this 1.3 level with the green line, that might mean that the market's overextended as well. Still looking good longer term. 10-day average of the highs and lows for the S&P still coming up above the green line. And above all the moving averages with all the indexes here, and the moving averages are all going up as well. And above zero and going up with the 5-period moving average of the highs and lows across the broad market. And not a big change here with the stocks above their 20-period moving averages, but we are more or less positive without being extreme. Right now, we have 75.6% of stocks above their 20-day moving average. 74.8% of stocks are above their 50-day moving average. 74.2 stocks are above their 100-day moving average, and 64.4. So this is showing some gradual improvement here and looking positive. So here's the daily chart. And again, I still have the red dashed line here from the previous all-time high, but we're still looking pretty constructive here from a bar pattern where we're seeing, for the most part, higher highs and higher lows as we've been advancing, and we are below average with volume. And still looking positive with the 20, 50, and 200 period moving averages on the S&P. We are improving with the Stochh RSI, but we're not above this 80 level or 0.8, which shows really more solid short-term momentum. But we are there with the Williams percent R, and we're turning back up and not looking extreme with the CCI 14, but we're still above this 100 level with the CCI 20. All of the stochastics charts looking more positive with the short, intermediate term. We're still below the moving average with the long term, but we're getting an extreme reading and it's trying to turn back up. And we're coming back up about to the midpoint with the force index where we actually drop below the midpoint, but we're still positive since it's above zero. Short-term trends still looking solid here with both the green line and blue line going up. We're still in the +3 standard deviations channel. Balance of power. Now, we don't get many signals from this one, but a little bit more. If we go above 0.3 here, that's going to be an extreme positive reading. And we usually don't use this as much as an oscillator because it's pretty slow, but that could be kind of a big deal if we get above this 0.3 level. Trending basis, though, both short and intermediate term, the lines are still going up and prices above all of the lines as we're setting another new all-time high. Still positive with the go, no go, darker blue bars. Still coming up to the highest high value here, the blue line, with the midline continuing to go up. And this is something that can go on for a while. There's no hard and fast rule about this. We're positive with the Landry Light, but we're going above this 40 level, and that usually means, at least according to this chart, that's where we're getting a little long with the overall trend. Also, the proper order continues to be positive. Starting to go above the black line here with the TTM squeeze. That's when we pay more attention to this since it's starting to look extreme. And still just kind of hanging out above zero with the ease of movement. This has been interesting here. This indicator usually moves more than it has. It's stayed positive, but it's not really showing an awful lot of conviction. And we are turning back up and getting a positive reading with the Arun since the oscillator is above zero, showing there's more buyers than sellers. And turning back up above zero here with the S&P McClellan oscillator. So we're going up based on price and volume for the summation indexes. And an improvement here with the NYSE McClellan oscillator, turning up above zero. So the NYSE summation indexes are also advancing based on price as well as volume. But we're still declining with the Swanland trading oscillator. For some reason, we've been going up here. It doesn't like what it sees. So that's a little bit of a warning sign there. We are positive from a momentum basis, the PMO, but we're getting a very high reading here above its moving average, and we are positive based on price and volume. A little bit of an improvement above 50 with the PMOs that are rising. Tiny tick up here with the buy signals. That's also above 50. And we're pretty much flatlining right now with the PMOs that are above zero, right below this green line, which would be extreme. And we're still neutral, though, with the Elder's Impulse system for the S&P, but we're positive with the parabolic SAR. And then we look at our oscillators. Short-term slope oscillator above the green line. It continues to go up, so it's extreme, but it's positive nonetheless since it's above its moving average. The MACD kind of flattening out a little bit, but still above its moving average. So the short-term and intermediate-term oscillators are more positive, but a lot of them are extreme positive. Now we're starting to see the long-term oscillators cross above their moving averages, but we're really close. We're not quite there with the KST, but we're already above the green line here with the tricks, and that's showing more of an extreme positive reading. And the Copic curve continues to be positive. We're pretty much flat with the Sean trend meter, but it's still positive. And above 50 and advancing with the money flow, and also above 50 and advancing with the ultimate oscillator, above the moving average with on-balance volume. Starting to get extreme in the intermediate term RSI. That's based on 14 periods, and the short-term RSI based on 9 based on 9 periods. Intermediate term trend still looking solid. We're hanging out about on the red line here, and that's a triple exponential moving average, so it moves faster. But both the red line and the blue line continue to advance above all the plotted moving averages, but we're far away from the 20 and 50 period moving averages. But we've been that way now for a number of days. And we did advance again here with the bullish percent index. We're at 75.8, and you can see other times we can get around that 80 level, maybe even a little bit above it before it starts to top out. But we treat it as extreme whenever it goes above 70. So just a little warning sign there. We're continuing to go up with the NYSE bullish percent index, but we actually declined with the NASDAQ 100 bullish percent index, but it's still extreme since it's above that 70 level. Praying bottom fisher still generating a buy signal now. And here's the weekly chart. We're up 0.02%. So Friday will probably be the day that decides are we going to have a positive week or a negative week, because we're pretty much back to unchanged on the week so far. But the trend looking positive. The Heiken Ashi has the open candles. We're pointing up in black with the Kegi chart. The Renko chart is positive, and the three-line break chart continues to be positive. Now we're getting a little bit close here with the 150 moving average study. I have a red line here at this 350 level, and now we can go above that, and we've done that before, but we get a little bit concerned from a longer term perspective if we get up to this red line and then actually go above it. We still have a ways to go with the 200 period moving average study, but for right now, these are showing the long-term trend is improving as well. And they still won't change the small caps for some reason. Everything else is positive on all time frames. We're still positive across the board with commodities based on price. Bonds are positive based on price in the short and intermediate term. The dollar continues to be negative on all time frames. And we had tech and communication. These are the three growth areas, and they were down. And so that's why a lot of the mega caps really underperformed. But we did see discretionary. That was the strongest area. So that really helped the market out there. So NASDAQ setting a new all-time high right at the open. S&P setting a new all-time high. Canada setting another all-time high here. And then we had discretionary BPI cross above 80. So that area is showing some real improvement. Oh, let me go back here. And then staples are actually having a bearish MACD crossover. And that's actually positive for the market since staples are more defensive. Okay, so kind of red and green, depending on what you look at here. Not huge advances. Apple was up slightly, as was Nvidia. Microsoft was down a little bit. Amazon down a little bit, but Tesla had a pretty good day. Google was up, but Meta was down. And here's the golden cross. It's getting close with the Dow, but we're not quite there yet. Now we're having some difficulty getting above this R1 pivot point here. That would really help the Dow a lot if we could get above that and then close above that. Of course, the longer we stay above both of the moving averages, the more likely the golden cross may actually end up happening. But we're still neutral with the diamonds with the Elder's Impulse system. Setting another new all-time high, just barely. I mean, the NASDAQ was only up 0.09%, but that's looking more positive. And we're still neutral. This is interesting. We were up, but we went from being positive to neutral with the NASDAQ on the Elder's Impulse system. And the NASDAQ 100, it was actually down a little bit, but still looking pretty solid. The Qs still remain neutral. And we're just flat right now as far as the momentum for the NASDAQ 100. And this is that long-term trend line going back to 2009 on a weekly chart of the NASDAQ 100. We're right at that level. And it could be providing some overhead resistance and causing things to slow down for right now. Here are the small caps getting above their 200-day moving average, but still below this R2 pivot point. But we are seeing some general improvement here. Still a ways to go to get back to higher levels that we were at back in 2024, but we are seeing things looking a little better here. Can we still see more follow through with this? We've seen some really good days only to go up and give it back, go up and give it back, go up and give it back. So, once bitten or 45 times bitten, 95 times shy kind of a thing. And we're still further above the 200-day moving average with the Russell 2000 small caps. Those are looking positive. Starting to get a little extreme with the RSI, but the momentum continues to be positive there. Positive with the Elder's Impulse system for the small caps. And not showing as much strength, up almost 0.5% here with the mid caps, but also above both moving averages. Still neutral, though, with the Elder's Impulse system. Then the Wilshire 5000. And it's a little, possibly just barely a new all-time closing high there, but still looking good that way. Also looking positive with the total U.S. stock ETF. Financial sector was up, but not back to a new all-time high. And we're back down to dealing with the 200-day moving average with the ratio between the financial sector and the S&P. So far, this area is holding. Are we going to be able to bounce up off of that again? FANG index, not a new all-time high here. It was down over 1%. So we saw a little bit of profit taking with the really big stocks, but they're still looking positive. So Apple was up 0.6% and Amazon down 0.13%, just now generating a golden cross. Microsoft was down, and it's been one of the stronger looking charts as of late. Google was up 0.57%, still above its 200-day moving average. Meta also down 0.75%, but a recent golden cross there. Nvidia up 0.75% and setting another new all-time high. Tesla is rebounding, but it's been really choppy lately here, and the moving averages aren't quite sure what to do at this point. Netflix down almost 3%. That's kind of a big move for Netflix, but it's still looking better longer term. And the semiconductors, they were up, setting another new all-time high with the Dow Jones Semiconductor Index. The SMH also setting a new all-time high in an uptrend here, starting to break out more above the previous high here, above the rainbow with the SMH ETF. And we are going up with the semis to tech ratio. That's more positive. Seeing a little bit more of a drop off with the short-term correlation between US and world stocks and a little bit of a drop down now in the longer-term correlation. Oil was down, so we're getting back more into the mid 60s. And here's the dollar. See, we have a ways to go just to get back to these moving averages, but it has been bouncing back up into the high 97 range. And we look at the latest reading from Truflation at 1.67% based on their calculations. And we were getting concerned about this, excuse me, the 4.5% level with the 10-year yield. It dropped and a little bit of a change here. That's helping stocks if interest rates continue to go down. And we're going back up here for the most part, even though we were down slightly with the 10-year based on price. We're back to even when we look at the yield curve between the 10-year and 3-month. All right, and then not really much of an improvement here, but still above the moving average that's slightly going up here with the Qs to S&P. Turning up, it's still below a declining moving average with discretionary to the S&P and still above the moving average when we compare large cap growth to value. So we're slightly above the moving average with the large caps, coming back down with the mid caps and still below the moving average with the small caps. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Okay, so no real change. We're positive on all time frames and we are trending. We're going to get the Treasury budget, so not a big day of economic data in Friday's session. But then anything geopolitical, that's kind of in the background right now, even though there's always still things going on between Russia, Ukraine, and Israel and Iran. And then any trade news that comes out or tariff news that might hit the markets. But the market seems to be getting more desensitized to that lately. And here is a look at the last day for the economic calendar. And the important things are pretty much done for the week. Seasonality is positive for the Dow and S&P for July 11th, where we're neutral to positive with the NASDAQ. Now we're going to be heading into options expiration next week. And we're up 57% of the time and down 43% of the time during options expiration. So we lean more to the positive side, but then after options expiration, we actually lean more negative. Okay, and I'm still in this period of positive seasonality that tends to go up about until the time of options expiration. And here's another look at that same thing. The green dashed line, that's what we follow during post-election years to get a guide for seasonal tendencies. We're still in the first half of July, which is the best performing half of the month going back to 1950. Positive seasonality for the NASDAQ, which goes about up until mid-July as well. So we just have the Swirling Trading Oscillator on here and the long-term special K chart, which I don't show in this video. I go over it in the weekend videos because we don't get very many signals from that chart. This is when I start to get a little more nervous because this is the negative side right now. And then we go over to the positive side and it's like everything is just firing on all cylinders. Again, it doesn't mean we're looking for a reversal. It just means that we might slow down a little bit. We are finally seeing our three smart money indicators looking positive at the same time now. And we have another addition here, the discretionary to staples ratio. We're seeing a golden cross with that ratio where we saw the growth to value ratio cross over a while back. But this is more positive longer term. And the McClellan oscillators and summation indexes are positive both for the S&P and the NYSE. The parabolic SAR continues to be positive, as do the bullish percent indexes for the three indexes that I follow. And our momentum oscillators They're looking extreme, but they are positive. And the ease of movement, money flow, ultimate oscillator vortex continue to be positive. Financial sector is still positive. So far, that ratio is holding. When we look at the financial sector to the S&P, we're bouncing off that 200-day moving average. And we're just kind of floating along sideways now with the momentum of the NASDAQ 100. And then we have a praying bottom fisher buy signal. Again, I don't really know that we hit much of a bottom, but it's still generating a signal. So here are the pivot points for Friday's session that are on the YouTube community tab. So no change to the overall conclusion. Positive on all time frames, and we are trending. Thank you. Have a really good day on Friday, and I will talk to you in the next video.